Thank you very much, and welcome everyone to this very, very exciting discussion that we're going to have today on taxation of virtual digital assets. So the subject is extremely exciting. It clearly takes a lot of mind space these days. You cannot pick up the newspaper any day and not see some headline on the other around crypto. So we hope today we will clarify the whole new regime around taxation of crypto for you guys and try and address as many questions as we can. So do post questions in the chat box and we'll try to take it towards the end of the session. I'm also joined for this discussion today with CA Rohit Arora. He's a young chartered accountant and has been following this space of crypto actively. Rohit will take some parts of this discussion, and I'll also pose some questions to Rohit along the way. So with that, let's start with the discussion. So while the presentation is being put up, just as a background on this entire technology, cryptography and blockchain. So this all began, at least in the current form as we know it, back in 2009. A lot of you may have heard the story, but it's very interesting, so I will say it. After the 2008 financial crisis, there was a need felt by some quarters that why should there be only a central authority which issues currency? Why should there be no transparency around currency? So why should only a government control it? So that was the need that was felt in some quarters, and with that need, there is we don't know if it's a real name or a fictional name, but a person called Satoshi Nakamoto. No one really knows his identity. He first started Bitcoin. So he wrote a white paper around Bitcoin, and that's the genesis of crypto as we understand. We all know about Bitcoin. It was intended, the use case for Bitcoin was intended as a currency, an alternate to central government or central bank issued currencies like the dollar and the yen and the Indian rupee, etc. And it was intended to be decentralized and completely transparent to all the users. So that's how crypto was born. And since then, this technology has been used extensively for other use cases. And we will talk as we go along a little bit about these use cases. If you go further, Rohit, what we are covering today, we will talk about the background of crypto. How does the whole technology work? So that's the first portion. Then Rohit will take for the audience a discussion on internationally what's happening around in this ecosystem. And then finally, the last section will be on the taxation aspects which have been introduced by taxation by the Finance Act 2022 around taxation of VDAs. So that's the broad flow that we'll have for the session today. This page throws up a lot of the key themes around crypto and virtual digital assets. So blockchain is the center of it. We'll talk a lot about it. Cryptocurrency are the tokens which are used. There is, of course, the e-wallets, the whole technology, data, private key, again, a very important construct. Some of this you'll hear as we go along in this presentation. Let's go further. Yeah. Okay, so this is the most fundamental, as I said, portion of how this whole technology runs, which is blockchain. And I will read a little bit of this, which is very important. A blockchain is a decentralized ledger of all transactions in a network. So it is decentralized. And hopefully everyone understands ledger using blockchain technology. So this technology always existed, or rather existed earlier than 2009 as well, but it was used to create Bitcoins first and then other use cases subsequently. So using blockchain technology, participants in the network can confirm transactions without the need for a trusted third-party intermediary. So we're all used to intermediaries in everything that we do. Any company you deal with, essentially an intermediary for you. And that's the same case for, when you're dealing with the government, etc. So here, intermediary or a central authority is replaced by a code, an algorithm or a computer code, which is on the blockchain. So that's what this whole concept is, how it replaces a central authority with a code, a piece of code which everyone can rely on. Powerful applications include fund transfers, voting, and many other uses. And we'll talk about this. So broadly, this page also, gives you a flow of how a typical transaction will work on a blockchain. So let's say there is someone on the network who requests for a certain transaction. And this transaction could be, let's say, I want to transfer X number of Bitcoins from person A to person B. Let's say I am person A, I want to transfer it to person B. So I will broadcast this transaction on the blockchain. Now this transaction has to be validated by someone. Okay, so there are a number of people who act as validators, and this can be anyone, you and I, who download that blockchain or that software can become validators. So there is no criteria for that other than to have, to become a node on the blockchain. Now the blockchain itself, let's assume it's Bitcoin we are talking about. Within the whole blockchain has certain complicated mathematical puzzles which need to be solved for a new transaction to be added to the blockchain. So people compete with each other to validate that puzzle, and when they are able to validate it, they can then include this data about the transfer from person A to person B on that block, which has opened up because they solved that mathematical puzzle. So they are able to put that data onto that block, and that block is added to the chain which is in existence. And for that activity, this person is called a validator or a miner. He gets certain Bitcoins, and that is a formula within the blockchain that if, let's say currently it's X number of Bitcoins are going for every puzzle that you solve. And likewise, it keeps reducing over the years because there are only finite number of Bitcoins that can be mined. And once, that whole validation is done, it's added to the block, and that's how the transaction is complete. So this is the typical flow of how a transaction works. Now, when the data is added to the block and a block is added to the blockchain, this is available to be seen by everyone on that blockchain. And that's where the transparency comes, that anyone is able to see it at any given point in time. So that's typically how a process works. Now, if we go further, some of the concepts we'll discuss on how this whole blockchain works. So the first concept is distributed ledger. So as I said, every node on that blockchain, and anyone can become a node by downloading that software, has transparency to every block on the blockchain, and therefore has visibility to, let's say, a certain number of Bitcoins, who is the owner of those Bitcoins. It's all transparently there on chain, as the industry calls it. So it's all available on that, and that's how it's considered a distributed ledger, because it's not centralized. It's available for everyone and anyone to see. Cryptography or encryption is the technology which is used to encrypt the data on the blockchain. So that is very typical. It's nothing unique here. Encryption is used in many ways. And then for decryption, there is the concept of the private key. For me to actually decrypt that and see that, I need a private key or a password, let's say, to do that. So that's cryptography. Consensus is very important. So as we discussed earlier, when one validates a transaction, he cannot automatically put it on the blockchain. That is then shown to other people on the network, okay, other nodes on the network. And when those other nodes confirm, yes, we agree that this answer, this puzzle that you've solved is correct, and that's the consensus mechanism. More than 50% of people, so it works by majority. Once there is consensus, that's when the block is added. So this consensus is important, and that's how there's no central authority, because it works entirely by consensus or democracy. And then there is smart contracts, which is you could run additional business logic or an agreement. And this is, let's say, there's another blockchain called Ethereum, apart from Bitcoin, which works entirely on smart contracts. So smart contracts are essentially what if functions. So what happens if this happens? Okay, and this is all effectively a code that if, and I'll give you one example. Let's say an insurance agreement can be put as a smart contract. So let's say a farmer takes crop insurance against some vagaries of weather. Okay, so what the smart contract will say is that, let's say, if there is more than X amount of rainfall, then insurance will be paid out because there will be damage. So that's a smart contract. And then whenever those events happen, someone will go validate, someone will then, there will be a consensus. And if all the nodes agree that, yes, indeed, there was this rainfall and this event has happened, then the insurance money will be paid out to the farmer. So that's at a very, very high level, a smart contract, which can be again put on the blockchain. And therefore, in this example, which I just gave you, there is no insurance intermediary. It can be entirely managed by a smart contract or a piece of code. So that's the other essential element of how blockchain works. Let's move forward. So now we only hear about cryptocurrencies, Bitcoin, Ether, so many. Recently we heard a lot about UST, etc. Those kind of coins as well, Luna. So what are these, and how do they come about? So let's get into that. So when Satoshi Nakamoto first launched Bitcoin, basically what it was there was a blockchain. The use case of that blockchain or the application of that blockchain was currency, and Bitcoin was a native token of that blockchain. Okay, such that when people and the nodes did certain activity of validation of consensus, they received that native token. So that's how it's a self-fulfilling concept, the whole blockchain concept. So the stages in that are, let's say, I come up with an idea or a concept or a use case. Like Satoshi Nakamoto came up with a use case for currency. Then there is this, let's say, Buterin was another person who came up, or a group of people who came up with Ethereum. So likewise, there are different people. There is Solana, various other such blockchains which have different use cases or concepts. So there could be currency, there could be smart contracts, XYZ, various kinds of use cases. So whoever is the originator will first come up with an idea or a concept, and then the whole blockchain is developed, and that entire thing is coded within the blockchain, whether it's smart contract, whatever it is. And the second stage is, now when I've come up with a use case, how do I make it independent? All the features that I described, that there's no central authority, there is decentralization, and there is complete transparency. All of those elements, how do I ensure that? So the blockchain, when certain activities are performed, issues tokens, and each blockchain will have a native token, and that's why you hear about different tokens at all points in time. So those tokens could be either earned as rewards for doing certain activities on the blockchain, or those tokens could be issued in the form of initial coin offerings, or airdrops, or various such forms of distributing tokens. And then the actual game begins. There could be decentralized applications, like as we spoke about smart contracts. It could be a currency application like Bitcoin, and then the miners get into action. They validate and they earn coins, and then those coins are the ones which are traded on marketplaces. So if you notice in this entire life cycle, there is a use case at the heart of it. Then how do the proponents of that use case ensure that the whole thing is self-fulfilling, self-sustaining, without the need for a central authority? That whole thing comes through the concept of these tokens. They are the incentives for various validators or miners on the blockchain to work on the blockchain. And as the amount of applications increase on the blockchain, so like Ethereum, we spoke about it. The essential concept in Ethereum is a smart contract. Smart contract can have hundreds and hundreds of applications. So as business people, as people actually write applications to ride on that blockchain, on the smart contract concept on Ethereum, let's say, the amount of value locked in the Ethereum blockchain keeps going up, because let's say an insurance company or a person has written an insurance application, someone has written a banking application. So various people will write apps or create apps riding on that blockchain concept, on that use case of the blockchain. And as the amount of volume or value locked, as it's called, increases, the value of that coin can keep going up. So, Ether will keep going up as, more and more people adopt the smart contract blockchain for running various applications, decentralized applications, or decentralized finance application, that's called DeFi. Bitcoin, the main use case is currency. So as more and more people start accepting Bitcoin, that's how the value of Bitcoin will increase. So there is always underlying value in the blockchain, in the currency or the token that is there. So as a lot of people invest, that they should actually understand what is the underlying use case, and what is the value lock. So it's a little bit similar to fundamentals of a stock on the stock market. So of course there is a lot of volatility that is there, but still there are some fundamentals that play out even in the blockchain and in crypto. Let's move forward. These are the various kinds of tokens. So there could be a payment token, which is a medium of exchange we spoke about, like a Bitcoin. There could be utility tokens. So these tokens could be issued, for various things. They give users access to future products or services. So for example, someone launches a new browser, they could give tokens for people to use the browser, and those tokens could give them enhanced features in future. So these are utility tokens. There are security tokens. For example, there could be an underlying security against which tokens could be issued for fractional ownership. So I could have like this PAX-G is a token which rides on gold. So there is actual underlying gold which is purchased, and against that these tokens are issued. So you don't need to actually trade gold, you can just trade the token. So those are security tokens. And then there are asset-backed tokens. So these are tokens like what typically are NFTs, non-fungible tokens. So they represent a unique asset in every situation. So it could be a painting, it could be a bottle of wine, it could be a digital art, like you may have read about this very famous Beeple collage, which was sold for $70 million almost. It was a digital collage of digital art. So that is the whole NFT, where ultimately the ownership is on the blockchain, but underlying there is an asset always, like a painting or a let's say a wine bottle or something like that. So that's the asset tokens as we spoke about. Now, very briefly, I'll tell you the journey in India of crypto. So 13 to 17, the central bank was continued to issue advisory that it's very, very risky, and investors should not get into it. Then in 18, somewhere in 18-19, the central bank actually issued a diktat asking banks not to allow companies who deal in crypto to bank with them. This was challenged by the industry association, IAMAI, which is the Internet and Mobile Association of India. This was challenged. IAMAI challenged this, diktat of the central bank in the Supreme Court. Supreme Court in 2020 quashed this guidance, and they said that this action of the central bank is, disproportionate to the need of the hour, and they asked, government to actively consider and come out with active regulation. So, as things stand today, there is no express bar in India on crypto in any way. There is no illegality in the crypto business, as we understand it. And we believe the government is in the process of creating some form of law. In 2021, there was active expectation that that law will be tabled in Parliament, that's been delayed. And then finally, in 2022, what happened is what we are discussing today mostly, which is the virtual digital asset taxation regime was introduced in the budget, and then passed in the law. So we'll talk about that. So that's been the journey so far. Big picture in India, we currently are in a bit of a gray zone on the regulatory front. But tax-wise, the government has levied a, express tax and provided a full regime on that, which we'll discuss. With that, I will request Rohit to talk about, the international developments. Rohit, sorry, I overran my time, so request if you can do quickly so that we can get to the tax piece rapidly.
Sure, Amit. Thank you so much for setting the context and giving us the background of the technologies and the ecosystem. While a lot of tax professionals will have fair idea or will be very well versed with the tax principles, it is important to understand the technology and what is it that we are dealing with to be able to apply the tax principles and to take tax positions around it. So it was really helpful. With this, we'll just try and understand what is happening across the globe, because this is an evolving sector. We are right at a nascent stage, and this ecosystem is yet to mature. So it's not like globally countries are also ahead of us. It's like all of us are in the same journey. So like you explained briefly that India is right in the middle of the spectrum, where we do not have a fixed regulation governing digital assets or cryptocurrencies, but it is not illegal as well. If we look at some of the global examples in this slide, we'll see that there are countries that have regulated cryptocurrencies. El Salvador has gone on to make it a legal tender as well. And there are other countries that have regulations around the players in the sector and what all assets can be part of this ecosystem. Similar to India, there are other countries where there is no fixed regulations as of now, and the government is being very watchful of what is happening in this space. And in due course, it is expected that some sort of regulations will come in. And there are some countries that have gone on to take an agnostic view of digital assets. They have brought about bans, and there are even punishments, monetary and imprisonments for dealing in cryptocurrencies. So just in a nutshell, what is the rationale for all of this? The policy framework depends on what is the type of innovation. Do we want to promote the innovation, but at the same time we have to be mindful of the integrity, because it is people's money that will be invested, and we have to be sure that the money is secure to that extent, and we have to be careful about the hard-earned money of the investors that has been put into the system. So this is either the licensing framework, to have a fixed licensing framework, either a sandbox regime or a rather comprehensive regime. Governments are contemplating whether to go around maybe innovation sandbox sort of an approach. Then there are regulations around money laundering and combating the financing of terrorism. Because of anonymity involved around blockchains, there are concerns whether, if required, can the government identify the trail of transactions and take any actions. So that is one aspect of it. Then is access to international markets. How will people sitting in one part of the world invest and trade with securities and assets in the other parts of the world? And there is also, in relation to India, there is also gray area on whether this is currency or commodity, or is it a sort of a security. So that is where I think a lot of deliberation is being done for specific characterization of it, because that will decide on what regulatory body will go on to introduce regulations for this. About the concerns of the jurisdictions that have gone on to restrict it or ban it, it is mostly related to financial crimes. They are apprehensive that this may impact the financial system and the monetary policy, because it will be like a parallel flow of currency in the system, and there will be effect on the environment. We've read about how Bitcoin mining can take a toll on the environment, and about greenhouse gases emission that it can cause. So these are the broad factors that are that the regulators across the world are mindful of while setting out their policies. With this, we'll just quickly try and understand few examples of how other jurisdictions have framed their taxation policies. So if we talk about the United Kingdom and United States, both of these countries have, although the term is cryptocurrencies, they have gone on to say that it is not actually a currency, it is similar to a commodity and property. And guidance has been issued on the websites of the official websites of the tax department, with examples that has gone on to explain how tax positions can be adopted by users dealing in digital assets or cryptocurrencies. So regarding United Kingdom, the HMRC is of the view that this is not currency or money, but it's more equivalent to a commodity. And the treatment will depend largely on the nature and use of tokens. Also, it has been clarified that a lot of entities pay their employees or even consultants in form of cryptocurrencies, and that is when it has been clarified that you have to convert it into money's worth in sterling pounds and have to pay it as taxes on employment income. So that is about the United Kingdom. Similarly, in the United States, there have been comprehensive listing of the transactions that are taxable and the transactions that are not taxable. So if you're selling cryptocurrencies for cash, paying for cryptos, then buying one crypto with another, these are all the transactions that are taxable. However, if you are buying cryptos with cash and are withdrawing from wallets, those may not be taxable. Any donation to charities, these may not be taxable. So these guidance are evolving, but these countries have come out with some sort of tax approach on the digital assets. Similar is the case with Canada.
So should we move ahead, Rohit? I mean, there are different details in this. You could just move further.
Sure, we can move ahead. Just on the global forefront, we'll talk about the OECD. Traditionally, we know about the exchanging of information in tax treaties, but they do not usually extend to digital assets and cryptocurrencies. Now, with the scale of it, OECD had come out with a public consultation document about the crypto assets reporting framework that plans to bring in transactions of cryptocurrencies for automatic reporting with the governments. Although this is at an initial stage and this will be discussed later towards the end of the year in the G20 meeting, but going forward, there is possibility that this will also come under the ambit of automatic exchange of informations, and crypto exchanges, crypto intermediaries have to plan for this, that they have to abide by the reporting requirements, if any, that are brought in by the OECD and agreed by the respective jurisdictions. So moving ahead, this was one buzzword during the budget speech, that India is also going to introduce a central bank digital currency. Also globally, a lot of other jurisdictions have talked about it. Just as an understanding, is it akin to cryptocurrency just because it is digital? Well, I would say if you look at the characteristics of it, it is quite different from cryptocurrency, as it is just a digitized version of fiat currency. So although the mechanics have not yet come out, but if we talk about the Indian rupee, if it is digitized, will it be like the Indian rupee, which is in physical form? Yes, because the value of it would be backed and would be stable, and there will be no tradability to say that the demand and supply would dictate the value or the underlying use cases. So it is more on overcoming the challenges of physical currency, which may include theft or soiling of notes and cost associated with various intermediaries. You have Visa, MasterCard having their share of transaction costs. So can this all be eliminated to bring in cost-effective transfers? That is more of the use case of central bank digital currency rather than the cryptocurrency in the traditional form that we understand. So with this background, I think, well, Amit, we can move to tax aspects.
Sure. Thank you, Rohit. So while the slide's coming up, at a high level, there are three provisions of, which mainly have been introduced. One is the definition provision around virtual digital assets. We'll talk about that. Second is how a transfer of a VDA is taxed. And third is around withholding, how withholding is to be done in case of a transfer of a VDA. And then there is a piece around income from other sources, that if you receive a VDA as a gift, what happens? So those are the 3 or 4 elements which we'll discuss. First, let's talk about definition. Very interesting. Any information or code or number or token not being currency generated through cryptographic means or otherwise by whatever name called, providing a digital representation of value exchanged with or without consideration, with a promise or representation of having inherent value, or functions as a store of value or a unit of account, including its use in any financial transaction or investment, but not limited to investment scheme, and can be transferred, stored, or traded electronically. So, 3 key parts to this. One is information, code, number, or token. Second is generated through cryptographic or other means. So it can be cryptographic, which is the encryption technology we spoke about, or any other technology. Then it should be, either a representation of value, unit of account, or so this is the third element. Sorry, I said 3, but there are 4. And the fourth and the most important is it can be transferred, stored, or traded electronically. So these are the 4 elements to the definition. Again, I repeat, simplistically, information, code, number, or token. Second, generated through crypto or other means. It should represent value or be a unit of account. And lastly, can be transferred, stored, or traded electronically. So these 4 elements. Then there is a second limb, which is NFT or similar token by whatever name called. Then any other digital asset as the central government may, by notification, specify. So clearly they want to keep leeway as to what happens in future. So they've included this limb to include other, given the speed at which this technology is moving. Anything else they could notify. And then there is also further enablement the government has, which says that the government may, by notification, exclude any digital assets from this definition of VDA. And broadly, what we understand they would want to exclude here is things like the central bank digital currency, which they would not want to be treated as a VDA, even though that is actually intended to come out as a parallel to a virtual currency. But probably that's what the government will use this power for. And then there is an explanation where they say that NFT, so while they've specifically included the definition within the definition NFT as one limb, but they've also said that NFT means such digital asset as the central government by notification specify. So what this is telling us is that within that second limb of NFT, actually the government will notify certain categories which they want to include as a VDA, and others will not. Now, it's a different matter whether within the first part of the definition, which as you can see is so wide, NFT can also be included there. I mean, that's up for discussion. Probably it could be, given how wide that first limb is. But still, they've indicated that for NFTs, they will notify, which NFTs are to be included. So what are some of the issues? I already touched upon some, but I will talk about a few more. On this first one, just how wide it is, Rohit, you want to, you have a point of view?
So Amit, like you explained in the definition, it is a very wide definition, and there are concerns that as soon as this definition was discussed in the finance bill and the act, there were concerns whether airline miles, reward points, and coupons will be brought under VDA and under the regime of virtual digital assets taxation. But there is something that what we can apply to it is that the wordings that have been used are stored, traded, transferred electronically. So whether or not these reward points, coupons, airline miles can be traded, transferred, or stored electronically, this can be a useful factor to actually take a tax position on it. So if it is that only I can use it and it may not be able to be transferred to someone or traded, then we can explore the position that it should not qualify as a VDA. But again, it will depend on the facts of each case, and it has to be analyzed based on every particular item that is under the definition.
Right. Yeah, absolutely. I mean, given how wide this is, our ability to put any kind of restriction on this definition is going to be very, very difficult. And probably those, three terms that they've used, stored, transferred, and traded, that's where most of the focus will be, in times to come as people analyze it. The second point is on, it also seeks to cover assets which are digital representation of inherent value. Now, and I also saw some question around that prepaid instrument. Honestly, the width of this definition, it's almost impossible to say with conviction that anything which is represented in the form of a code or a token or a number, and which is created through cryptographic or other means. So probably cryptography or other means, the other means can take some color from cryptography, but it will be a very debatable issue by itself. So if simplistically, if you have to take it very widely, therefore any technology can be used to generate that number, and it represents value, and it can be traded, then it will fall within this definition. So unless the government clarifies, and as we saw, there is enough power that the government has taken within the definition to actually come out with clarifications on what can be included, what can be excluded. And we know, and we've heard in the press and in other public sources, that the government is working on some sort of clarifications to be issued around these. So we hope some of this will be clarified, but as things stand today, probably there is hardly anything that can be excluded, which has those elements which I described. And today there's, everything is electronic, everything is in the form of a code or a number. Everything, is generated through some technology or the other. So that's how wide this can be. The next one is on NFTs, very interesting. So like we spoke about asset tokens. So NFTs are effectively kind of a digital receipt or a record of an underlying asset or a service. So I'll give you some examples. So recently, IIT Delhi had a festival called the Rendezvous. And the tickets for that, as we understand, were actually in the form of NFTs. So NFTs can also be used as an access to an event or a service. Or NFT can be for collectibles. It can be a card. It can be a painting. So always there will, or most times there will be an underlying asset or some value. And therefore the question that comes up is that if NFT is also a VDA, virtual digital asset, and transfer of that NFT leads to transfer of that underlying asset, are there two separate taxable events that are happening? One is transfer of the NFT itself, and second is transfer of the underlying asset. So this could be an issue unless it is clarified in future. Let's move forward. Second, as I said, there are these four pieces. Second is the taxability of transfer of a virtual digital asset. So that's the second piece of law which has been introduced. So this is triggered on gains or income arising on transfer of a VDA. It is taxable at 30%. It's a flat rate, plus of course applicable surcharge and cess. There is no deduction allowed for any expenditure other than cost of acquisition. So that's the first part. Then set off of losses arising on sale of VDA is not permissible against any other income. So if I have loss from this VDA source, I can't use it against any other income, which is logical because they have a flat rate of 30% on this VDA. There is no carry forward of losses arising on sale of VDA. So if I have loss, I can't use it against anything else. I can't carry it forward. So it's effectively a dead loss. Then the other way around is also true. Losses from any other source cannot be set off against the income from transfer of VDA. So they are completely ring fencing in a way the income from VDA. And then transfer, the legislature is saying that you have to use the transfer definition in 247. whether VDA is a capital asset or not. So that's broadly the scheme of taxation. So in summary, I would say it's introduced under Chapter 12, which is income from rates on special rates of income. It has a full mechanism for how it would be taxed. It effectively is trying to ring fence this income and levying this 30% plus surcharge cess on this income. So that's in summary. Now, the second part which we will discuss before we go to issues, if we move forward, is the gift provisions. So 56, which basically says that if you are receiving in the form of a gift or receiving any property which has more than 50,000 rupees in value, either at zero rate or at lower than fair market value, then that delta is taxed in the hands of the recipient. So we are all familiar. Of course, there are some exceptions that if you receive it on your wedding, etc., those are exceptions. But by and large, that is the provision. So in 56, the small amendment they've made is they've made virtual digital assets one of the limbs of property. So if you are receiving a virtual digital asset, that will be taxed in your hands as long as it's more than 50,000, or more. It will get taxed in your hands. So that is the income from other source provision they've introduced for VDA. Now let's come to issues. I mean, there are a plethora of issues that arise in this. The first one and the most interesting is, if you notice, I said that they're trying to ring fence income from transfer of VDAs in one box and trying to tax it. Now the question that arises, now there are two non-obstante words used in this provision. It starts with non-obstante in the opening provision under 1, and in the computational aspect again it says non-obstante, notwithstanding that no other law, notwithstanding anything, no losses will be allowed. Notwithstanding anything, 30% rate will apply. So there are two non-obstante clauses within this section. So the question that arises is that it says, notwithstanding anything, no losses will be allowed to be set off. The only thing which is allowed as a deduction, as we said, is cost of acquisition. So question is, losses, does it include loss from sale of any other VDA? So loss within the same source, if you will. So I have, I do 2 VDA transactions in a financial year. In one, I make profit. In another, I make loss. Can this profit be set off against this loss? Now, this question was posed to the government in Parliament, and the Minister of State for Finance actually answered saying, we are not going to allow it. So he has, given this clarification on the floor of the Parliament. It's a, start question or unstart question, I think. So it is available in public domain, this clarification. So that clearly seems to be the intent of the government. The language, if you ask me, is a little gray. It could be argued both ways. But given that the government has expressly clarified, and probably that's the intent of the law, this will be an issue. And therefore, maybe the ring fencing or the box that I mentioned only is around the gain, and you can't even set off losses of another VDA transaction against this gain. So that's the first issue. The second one is on heads of income. Now, this is another, since this is under a special, income under special rates, how do we classify it as under a particular head? And, classifying income under a particular head, of course, is very relevant because various things flow from that, including, interest under the 234C, where capital gains has some benefits. So if it is capital gains, you can get those benefits, otherwise you don't. So some of those things are relevant. And therefore, you will need to classify this under a particular head of income and decide whether it's, let's say, business income, capital gains, income from other sources. Those are 3 possibilities. So that's the other one, which is interesting. Then the question is transactions which are not regarded as transfer under Section 47. Will that come to the aid? And therefore, let's say you are merely, donating crypto. Or some other, a parent is giving it to 100% subsidiary. Some of those exceptions in 47, can those come to the aid? Again, the question therefore that will be, is it a capital asset? Because capital asset under 214 is separate from VDA, which they have defined in 247A. So the question is VDA a subset of capital asset? Probably, the VDA itself could qualify. Someone will need to analyze it in detail, but probably may qualify as a capital asset. And then, these 47 exceptions may be available. So something interesting to keep a lookout for. Rohit, you want to cover the next 3 or 4 some interesting issues? Just would like your views on those.
Amit, one pertinent issue that I was wondering is that we do not have a fair market value process or guidance on how fair market value would be determined for digital assets. So if I were to make a beautiful painting today and if I gift it to you, and instead of just then I do have mechanisms to determine the fair market value. But if I were to digitize it, and instead of putting it as an NFT on a marketplace, if I gift you the NFT, while you may be willing to offer it to tax under section 56, you will be in a fix to ascertain the FMV, because the current rule 11 UA does not quite deal with the FMV aspects of digital assets. So that is one particular area that I think some guidance will come up in the future regarding the fair market value. Another aspect is that it has been provided that no deduction other than cost of acquisition will be allowed. However, this word is cost of acquisition and not essentially only cost of purchase. Again, one question was posted to the Honorable Minister of State for Finance in Lok Sabha, whether the cost of mining will be allowed as cost of acquisition, to which the answer was in negative, and it was said that this is essentially infrastructure cost and not really the cost of acquisition of a token or VDA. So this, although what his answer is states the intent, but it is not enshrined in law, and there is already a whole lot of jurisprudence on the issues. So if this matter was to go to courts for interpretation, how would they interpret it to say maybe it is only on purchase that I will get a deduction of cost of acquisition, or even in case of self-mining, I am entitled to claim it? That is something that needs some deliberation. Apart from that, another important issue is if I buy 10 VDAs on 10 different dates, and if I'm selling it, so selling one of them, how do I determine what is the cost of the VDA that I'm selling? Is it FIFO? Do I need to do weighted average? I remember there is a old circular which says in relation to shares held in demat form, there is this first in first out method that I need to follow. So whether is there anything prescribed for VDAs as well, or will it be prescribed, that we need to look out for?
Thank you. Thanks for your thoughts, Rohit. So in the interest of time, and there are a lot of questions which we'll want to take, let's just spend maybe only 2 minutes on 194S and we can get into questions. So 194S is a new provision for withholding, which again says that any person responsible for paying any consideration to an Indian resident for transfer of a VDA is required to withhold taxes at 1%. And then it also goes on to clarify that if it's a VDA to VDA transaction, which means you're exchanging one cryptocurrency for another, that will require you, before you transfer the VDA, to ensure that the recipient has already paid that 1% TDS, and only then VDA can be transferred. So that broadly, and then there are some limits of, for an individual and an HUF, the limit is 50,000 if you are a payer, that at least 50,000 is the amount beyond which the withholding is to be done. And if you're a company or otherwise, it's 10,000 rupees. So that's important. So that's, in summary, 194S. There are a plethora of issues on S. If you go forward, Rohit. First one, and very important, is person responsible for paying. So as I said, the provision is any person responsible for paying any consideration. That's how the section begins. So who is person responsible for paying, especially in a situation where, let's say, a buyer is buying crypto from a broker who executes the trade on an exchange, on which there is a seller who's made the sale. So there are these 4 different parties. So consideration will come from the buyer to the broker to the exchange to the seller. So who is in this leg the person responsible for making the payment? So that is a very live issue. We hope this will get clarified. Someone might argue that it is just given the phrase, it is every person in the chain, but that will clearly lead to cascading. So hopefully this will get clarified. So that I think that is a key issue in this. We'll just park the other issues. People can see it, it's on the screen, but I do want to take questions that have come up. Lots of questions. So first I'll start with the first one. If crypto is purchased from a foreign based company or platform, TDS does not need to be deducted, is the question. So if you see the language in 194S, it says that any person responsible for making a payment of a consideration to a resident. So the recipient of that payment should be a resident. For the payer, the section at least does not give any restriction that it has to be a resident or a non-resident. One can, of course, explore arguments that can an Indian law apply to a non-resident and those kind of things. But as the section stands, there is no restriction that seems to be there. Then there is something on, sorry. Next is, would prepaid payment instruments constitute VDA? We already spoke about this. The definition is very wide. So it will be, if it meets those elements, probably it will fall within the definition, and we hope the government will clarify something around this. Hi, Rohit, you spoke about salaries. How are salaries received in crypto taxed, keeping in mind the new provisions of the law? Rohit, you want to address that?
So currently, although there is a special tax regime for cryptocurrencies, but we have to classify it under one of the heads, but it is taxable at special rates. So in this, valuation aspects would also be critical, and then the application of higher rates would have to be done on the valuation aspects, keeping in mind the special regime.
So I will just add there, see 115 BBH, which is the regime, is only on transfer of VDA. If I'm simply receiving salary in the form of VDA, I would reckon that will get normally taxed, as Rohit said, as salary. The person who's paying me the salary in VDA, if it is a transfer for him, maybe there is another taxable event in his hands or her hands or the person's hands, because there's a transfer of VDA. So in that sense, the recipient of VDA could be taxed just like normally. If he had received rupees, he would be taxed. And the payer of VDA could get taxed because there is a transfer from the, let's say the employer to the employee. And that's how I would answer that. Then how would the payment received in crypto for any services provided by an Indian resident be taxable, whether under 115 BBH or PGBP? So we just discussed this. 115 BBH is only on transfer of VDA. So wherever there's a transfer, it doesn't matter which head it falls under, you'll still be in the 30% regime. If it is not from transfer, then it is arguable that it can be, under some other head, like in this case, it could be PGBP, or in the earlier example we discussed, it could be salary. So that's how I would, again, this very early days, and hope maybe things will get clarified, but that's probably how I would answer it. Do crypto derivatives fall under the definition of VDA? So again, if those 4 elements of the definition, that it's a code generated through cryptographic or other means, and a store of value with medium of exchange, and then it can be stored, transferred, etc. If those are satisfied, then it would. But my understanding is that crypto derivatives, or the exchange traded funds, are actually just like any other security, right? So probably the intention is not to cover those kind of securities. Underlying can be anything. In this case, it's crypto. It could be a regular share of a technology company or anything like that. A derivative can be created for anything. But still, if it meets those criteria, there is an issue that can arise in the law. Whether chips, tokens, coins, or anything else provided by online gaming companies will be classified under VDAs. Very, very high risk that it can get classified, given the way the definition is, unless there are some restrictions or some clarifications issued. The only thing which Rohit touched upon, which you could look at, is if they are not transferable and can be only used in game. Okay, so you can use it for going to a higher level, etc., and therefore you can't really transfer it to anyone. That possibly you could, and therefore you need to see the features of that token or chip, and then decide. But it really will depend on facts of each case, but it can be very wide, the definition. Then the next one is gain from VDA can be set off against loss from another VDA. We discussed this in detail. So it's a live issue. As I said, government has clarified it. So maybe it may go against the taxpayer ultimately, but something to be certainly debated more on. What constitutes the cost of procuring VDA for deduction purposes? So cost of acquisition, and I think Rohit touched upon that. They don't define cost of acquisition. So we would reckon that the normal principles on cost of acquisition will need to be used. So just like, any other capital asset, what is the cost of acquisition? Similar principles will apply. There are no restrictions right now in 55 on cost of acquisition for VDA. So probably you could consider everything. And again, you do remember what the government clarified on infrastructure in Parliament and how that can interplay. Again, the next question is again on loss versus gain, which we discussed. Next is, what is the difference between VDA and other VDA, whether loss made from sale of Bitcoin? Again, lots of people have the same issue, which we've discussed. It is clear that transfer of NFT will attract a tax at 30% plus applicable surcharge and cess under 115 BBH. However, consideration in respect of such NFT will be paid in USDT, which in turn will be converted to INR. So whether tax will trigger at 2 times or only once. This is one at the time of transfer of NFT for USDT and then conversion of USDT into INR. In my understanding, there should not be any double taxation. So when I'm transferring an NFT and I'm getting a USDT in return, that is, 115 BBH will trigger because you are transferring it. Now, when you receive USDT and you are simply converting it, there is no transfer of that USDT, and 115 BBH triggers only on transfer. So I would, again, don't hold me to this, but I would say that this probably makes sense what you were saying. Rohit, you want to add? You agree with what I said?
So I think the question is that when I get USDT and I liquidate into INR, will it be?
Is there another taxable event? Yeah, that's the question.
Right.
Then the last question is, and we are bang on time, for a person carrying out mining as a business, what is the tax rate applicable, and are expenses incurred in setting up and running the operation tax deductible? So when I am mining crypto, okay, and we've said this multiple times, the new regime applies to, in the case of 115 BBH, to transfer of VDA, and 56 applies when when a person receives certain property without consideration or at less than fair market value. So these are the two specific provisions. Mining, I would reckon, doesn't fall in either, and therefore you would be just like any other activity. That's how mining would probably also classify. So again, I would say these are early days, and therefore do consider anything that we've said in this discussion as directional, which can get refined as we get more clarifications and as more thought is put into some of these very vexed issues. And we hope that this law becomes more and more clear as we go along. That's all we had, folks. Thank you so much for joining us. We really enjoyed doing this session. I hope you enjoyed as participants. Back to the Taxmann team.